I didn't want a part of the pie, I wanted all of it, right? So then from there, came across some deals where we learned creative finance. What is creative finance, right? So Henish touched on something that really stuck with me when he was talking about the numbers of if he took down the deal himself on hard money, the amount of money he would have to put down. Now, I don't know about you guys, but I want to put the least amount of money as possible into a deal. But if I have to, why not do the least amount as possible, right? So does everybody understand the fact of when you're doing creative finance, you're just coming up with not only creative ways, but you're learning how to become in the bank. Amortization schedule shows you how much your payments are each month and what payments going towards interest, what payments going towards principal. And when you look at the end of the 30 years, guess what? You pay probably double for your house in just interest.
I also speak Spanish. If we want to talk about amortization schedules in Spanish, that is a good time. Ready to do that. Lots of different ways to structure a loan, lots of different ways to get those rates comfortable for people. This is a good alternative to ARMs. ARMs are adjustable rate mortgages.
The perception of adjustable is like, okay, everybody heard about the mortgage meltdown in 2007, those adjustable rate mortgages. Since that happened, a lot of those stated programs they went away. And since then, financing requirements were that you had to prove that you could afford, that you had a job, that you could afford the mortgage. So all this time, everybody's been doing the traditional lending where there was money down, you had to prove your income, and you had to put down some money.
So this is the beauty of this, is it's just your regular old-fashioned fixed 30-year loan. It doesn't have that kind of variability, all these extra fees. It's just the standard, regular, nice, fixed, safe loan, but a little bit of kind of cherry on top that a seller can help for buyers that are feeling a little bit uncomfortable in this market. So it does a rate reduction of 2% from their standard note rate in the first year. So we were talking about prime 5.875 when you use that for my example. It takes, in your first year of those payments for that borrower, it's gonna take you down to a 3.875. This really takes some of that heat off for them to feel comfortable in that first year, knowing it's gonna go down lower. And then in the second year, it gives you a little bit of kind of a leeway into, segue into the next year, right? It's gonna be 1% less, it's gonna be 4.875, and then go back up to the 5.875.
Okay, so these are what the banks are doing. Now, if they're doing that with just your loan, right? How many other loans they're creating every single week, month? It's a lot of money, right? So imagine if you could do that.
So on a 5.5 ARM, I'll explain in the next what these different programs are in a little bit more detail, but on our 5.5 ARM, that's our lowest rate right now. It's at 3.375. So just that lower rate, even from a 4.625 and even more of a savings, you're going from a $3,400 a month payment to $2,900. So just alone there in just the interest rate is you're saving that much, about close to $500 a month.
So what do? We basically provide short-term capital for double closes. For those of you that are involved with assignments, they're basically falling out of order and out of favor in a lot of the country because they're illegal. Assignment means you basically buy low, sell high. You're able to do it on one transaction. A double close is obviously two separate closes or two separate escrows. The reason you do that is for two reasons. One, a lot of the country they've made assignments illegal. Ohio, Indiana, Pennsylvania, New Jersey, Rhode Island are the latest to join that parade. And those states that aren't illegal for assignments have made it uncomfortable at the title level or the escrow level because they don't want to get involved in what's known as daisy chains. Daisy chains means that you are a wholesaler, you buy it from one, you sell it to a second, you sell it to a third. So the answer to that is a double close. They're not illegal anywhere, and you have a separation of the buyer from the seller. With an assignment, everybody knows how much you paid for the thing. They also know how much you're selling it for because it's all involved in this contract that basically trails along.